The news dropped like a bomb. Netflix acquires Warner Bros. Discovery and the price tag, a cool $82.7 billion. The mainstream financial press calls it the King Kong of media. They're talking about Harry Potter meeting Squid Game, and they're talking about content library that rivals the Library of Alexandria. But we don't trade headlines, we trade structure. And the structure of this deal has financial engineering written all over it. Here is the detail that matters. Netflix is buying the studios and the streaming rights, but the linear cable networks, CNN, TNT, the dying cable bundle, those are being spun off into a new entity called Discovery Global. This is critical. Netflix is buying the assets, the intellectual property, and rejecting the liabilities, the dying cable business. In the debt cycle framework we use on this channel, this is a classic good bank, bad bank split. Netflix gets the gold, the new Discovery Global company gets the lead. So let's run this through our primary filter, the valuation model. The core principle of our filter is the best owner principle. It asks, is the business worth more in the hands of the buyer than the seller? Usually in big media mergers the answer is no, it's just empire building. But look at the WBD's return on invested capital. Over the last 3 years it's been crushed by the integration costs of the Discovery merger and the secular decline of cable. Their intellectual property, Superman, Batman, Game of Thrones, was dead capital. It wasn't generating the returns it should because it was trapped in a bad business model. Netflix has a higher return on invested capital because its distribution machine is global and frictionless. By moving that intellectual property onto Netflix rails, the same content generates higher cash flows. That is definition of value creation. However, and this is the big but, we should also work about the conservation of value. You cannot create value just by shuffling papers. If Netflix overpaid and 25x EBITDA is a rich multiple, then all that value creation goes to the selling shareholders, not to us, the Netflix holders. Okay, narrative is fun, but math is honest. Let's look at the return on invested capital, and this is the only number that matters for the long-term compounding. Right now, Netflix is a Ferrari. For every dollar of capital they invest in content and servers, they get 25 or 26 cents of profit back. That is elite. What about WBD? They are generating barely 2% on their capital base. That's a savings account, not a business. And now watch what happens on day one of this deal. Netflix currently has about $42 billion in invested capital. To buy WBD, they are adding roughly $83 billion to that pile, mostly in debt and new equity. So the denominator, the invested capital, triples overnight to roughly $125 billion. But does the profit triple? Well, no. WBD's assets are only generating about $3.5 billion in EBITDA. Right now, when you do the math, Netflix elite 26% return on invested capital crashes down to roughly 11% on day one. This is the return on invested capital cliff. So Netflix transforms instantly from a high-flying tech compounder into a capital-heavy utility. And here is the kicker. Their cost of capital is around 11%. If your return on invested capital equals your cost of capital, you are creating zero economic value. You are running on a hamster wheel. So why do it? Because they are betting on 3 scenarios. Scenario 1, the bull case. Netflix cuts $3 billion in costs from WBD. They fire the middle managers, close the redundant offices, and plug HBO's content into their algorithm. If they do that, no path shoots up and return on invested capital climbs back to 29% by 2027. If this happens, the stock can double. And we have scenario 2. The base case. So they get some cost cuts, but the debt interest is the profits. Return on invested capital gets stuck at around 14 to 50%, and Netflix becomes Comcast's 2.0. It's a safe stock, but the hyper growth days are over. And we have scenario 3, which is the bear case. This is the nightmare. The regulators delay the deal, the Discovery Global spin-off fails and dumps debt back into the parent company, and in this world, return on invested capital stays under 10%. That means they're destroying value every single day. So what is my take? The market is pricing in the bull case, but the math starts us at the cliff. Now let's zoom out to the macro. We are late in the sovereign debt cycle. Capital is expensive. You don't get to borrow at zero anymore. WBD was sitting on a mountain of debt, over $35 billion. The press release says Netflix is taking on some debt, but the toxic stuff is likely staying with the spin-off. Here is the risk market is missing. Who funds the spin-off? Discovery Global, the new company holding the cable channels, is going to be wallet with leverage. In this interest rate environment, that company is a default waiting to happen. If the bad bank, Discovery Global, implodes in 18 months because they can't refinance their debt, the contagion will hit the entire sector. It will blow out credit spreads for everyone, including Netflix. Netflix is trying to perform surgery in a dirty operating room. The idea is right, but the environment, this late-stage credit cycle, is dangerous. Let's pause. I want to argue against myself. I want to steelman the bull case. Why might this be the trade of the decade? Two words: pricing power. If this deal closes, Netflix controls the cultural water cooler. They have Stranger Things and House of the Dragon, and they have Squid Game and Harry Potter. They will have the power to raise prices by 20 to 30%, maybe 40% over the next 3 years. In a world of inflation where our purchasing power is being debased by the sovereign debt crisis, the only companies that survive are those with a pricing power. If Netflix can raise prices faster than inflation because they are the only game in town, then the $83 billion price tag is cheap. They effectively become a global utility for entertainment. It's time for our red flag of the week. Did you see the breakup fee, $5 billion? Netflix offered a $5 billion reverse termination fee if the regulators block the deal. That tells you everything. They know the Department of Justice is going to hate this deal. Linehan and the FTC have been hunting for a monopoly to kill like this for years. The market is pricing this deal as done. I'm telling you, it's not. There is a solid 40% chance this gets blocked. If it gets blocked, Netflix has to pay WBD $5 billion in cash. That is cash that should have gone to buybacks or content. It's dead money. So how do we trade this? I'm not giving you advice, but here is the risk map I'm using for my own book. We have a path A, the arbitrage play, and I'm looking at the spread between WBD's current stock price and the acquisition price of $27.75. If that spread widens, it means the market thinks the DOJ will kill the deal. I'm avoiding this arbitrage because the regulatory risk here is too binary and it's like a coin flip. We have also path B, the short junk play. I'm interested in the Discovery Global spin-off. When that spin-off starts trading, it will be a debt-laden company in a dying industry. It fits our debt cycle thesis perfectly. It is a zombie company. I will be looking for setups to short that spin-off once the dust settles. And we also have a path C, which is the Netflix pullback. If Netflix stock drops because of delusion fears or debt worries, I'm buying the dip provided the 10-year yield stays below 5%. If rates spike, all bets are off. And here is the bottom line. Netflix just tried to pull off the greatest heist in media history, taking the crown jewels and leaving the junk in the dumpster. But in a sovereign debt crisis, even the best houses are built on shaky ground. So watch the 10-year yield, watch the DOJ announcements, and do not get seduced by the headlines. If you want to understand how the debt cycle is going to impact your portfolio next, click this video here and don't forget to subscribe if you want the truth behind the data. See you in the next one.